Hey, how are you? I'm Duncan McPherson. Welcome back to my channel. Today is the fifth in this series of videos where I'll be discussing how you, as an American with Canadian business interests, might get overtaxed because of how differently our two countries view liquidations, reorganizations, and repatriations. Fair warning though, you should take no action on the information contained here today. What you should do is contact an expert who knows how to handle this if you should come across any of these issues. And as always, for more information on how you can better navigate the Canadian tax system as a US business or a US person, don't forget to hit the subscribe button and click that notification bell. Or skip the hassle and contact me directly at themactax.com and I'll fix it all up for you. First on the list is earnings and profits. Okay, my American friend, we do not use the term E&P up here. So if you start dropping that term to Canadians, we will not know what you are talking about. Well, I'll know it. So if you need someone else to know about it, contact me and I'll translate it for you. But if you're on the phone with someone up here, you can just tell them that the E&P calculation is sort of like the safe income calculation up here in Canada. And I'm only giving you this tidbit as a means to facilitate your conversation, nothing more. It is only so your Canadian counterpart will know what you're referring to by E&P at a very high level. And after that conversation, contact me to get the E&P calc done for you, okay? Okay, next we're going to talk about the Step Transaction Doctrine. Now, the Step Transaction Doctrine does not exist in any way up here in Canada the way it does in the United States. So if your Canadian counterparts are reorganizing in the United States and you mention to them that their plan fails under this doctrine, they will not know what the heck you're talking about. So tell them, hey, listen up. The Step Transaction Doctrine is quasi-related to your general anti-avoidance rule, and also your concept of series of transactions found in Section 55 of the Canadian Tax Act. Again, I am only trying to offer you relatable concepts to facilitate your initial conversations with Canadians when you need to. If you start dropping terms like Step Transaction Doctrine, your Canadian counterparts probably will not know what the heck you are talking about, which is why it is important to have someone on hand like me, to do the translation for you. But while I'm on the subject of Section 55, you, my American counterpart, should be aware that Section 55 is used in Canada to prevent you from using some trickery to convert capital gains into tax-free intercorporate dividends. And the rules are deathly complicated. Here is a book on Section 55, and this is the first edition, and it's over 200 pages long. The second edition is more than twice as long as this one. They made a lot of additions to the law. I mention this to you here to impress upon you that you may undertake certain reorganization transactions of your Canadian affairs, transactions that probably seem benign to you, but may unwittingly be caught under Section 55. The verbiage in this legislation as drafted inadvertently captures transactions that it was never intended to capture, transactions that are completely benign to you under US law. And if this section does catch you, expect a really ugly tax bill. So whenever you are reorganizing your corporate affairs here in Canada, always have an expert review it to ensure that you are not caught under the wide grasp of Section 55, or else get your checkbook out and be prepared to sell your house. Okay, now for our third topic. Okay, now let me tell you about IRC 1248 liquidating dividends. Okay, I'll keep this one short and sweet for you. If you liquidate a Canadian corporation, you do not get your basis back tax-free in Canada. So let me give you an example to illustrate this. If you pay $10,000 for shares in a Canadian corp, and 10 years later when you've grown the retained earnings to $50,000, the whole $50,000 is a deemed dividend here in Canada upon liquidation. However, in the United States, you would get your $10,000 of basis out tax-free, and the dividend would only be $40,000. But up here in Canada, you get a $10,000 capital loss carry forward for your basis, which can only be used in the future when you have a capital gain in Canada. Yes, we think this is really stupid up here too. So if the liquidation of your Canadian corp is on the horizon, start planning for this and give me a call. But you got to keep in mind that planning for this eventuality should begin on the day that you purchase the company. The earlier you start planning, the more flexibility you have and the less tax you'll pay in the end. All right, my friend, that's it for today. I know talking about this stuff as a securitist brainbuster, but let's be honest, you probably watched this far because this stuff is costly, scary for you. So if this is you, don't forget to call me at themactax.com and I'll make sure you don't ever have to worry about this. And as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and stay out of tax trouble. I'll see you on the next video.